Welcome back to Silver&Metal IQ, the place where we break down the latest gold and silver market news for investors who want the edge. I'm Peter, and today we're diving into a seismic shift in the silver market that could redefine the global precious metals landscape. If you think silver is just a sidekick to gold, think again. What's happening right now may be the biggest opportunity in years. Stick with me, because by the end of this video, you'll understand why physical silver is about to surge, why the gold-silver ratio is flashing a warning, and how global dynamics are converging to make silver one of the most compelling assets of the decade. China can no longer hide its silver accumulation footprints. Recent analysis from liquidity providers shows they've cornered enough global silver supply to let prices run higher. What this means is the synthetic overshoot of an undersupplied physical market, long manipulated by the cartel, is now being confronted head-on. The result? Analysts are predicting a physically driven rally that could force short sellers to cover their positions, while automated market algorithms respond in real time. Silver is now trading at levels that suggest profound undervaluation relative to gold. The gold-silver ratio, a key measure of comparative value, has surged to 101.1, even touching 104.1, historically extreme territory. For context, the ratio usually ranges between 40.1 and 60.1, meaning over 100 ounces of silver are needed to match the value of a single ounce of gold. History tells us that ratios this extreme precede major price corrections, signaling significant upside potential for silver. Renowned analyst Andrew Maguire highlights the scarcity in the physical silver market. Spot silver prices have flipped from an 80-cent discount to consistently trading above futures contracts, a phenomenon known as backwardation. At one point, the May futures contract showed an 82-cent backwardation, with spot trading nearly $1 higher. This reflects extreme tightness in immediate physical supply, a condition that cannot last indefinitely without pushing prices up. Demand is surging across Asia, particularly in China, where spot purchases increasingly counter traditional paper short sellers. India and Saudi Arabia are also contributing to the tightening supply chain. Meanwhile, silver is starting to decouple from broader stock market movements, demonstrating strength as monetary demand rises. Efforts to suppress silver through synthetic selling are faltering as cash-settled futures diverge from physical delivery prices, a sign that market capitulation may be near. This is more than a market anomaly, it's a structural shift. Silver is reclaiming its role as both an industrial metal and a monetary force. Physical buying is outpacing paper manipulation, setting the stage for a potential breakout. For those paying attention, the signals are clear. Strong Asian demand, backwardation in spot pricing, and extreme gold-silver ratios all indicate a market primed for a move. Before we dive deeper into global dynamics, market signals, and what this means for investors like you, make sure to subscribe to Silver&Metal IQ and hit the bell icon. You won't want to miss the insights we'll share over the next few minutes. The market is shifting, and knowledge is your greatest advantage. If you thought silver's story was just about prices, think again. Right now, the market is witnessing a clash between physical accumulation and paper manipulation, a struggle that's shaping the trajectory of silver like never before. Understanding this tug-of-war is critical if you want to protect your wealth and capitalize on the next silver surge. Over the past few weeks, the spot market for silver has flipped dramatically. What used to be an 80-cent discount to futures has now transformed into a consistent premium. This flip signals that physical buyers, particularly in China and Asia, are overcoming the cartel's attempts to suppress the price. Backwardation, a market condition where spot prices exceed futures, has reached nearly $1 at one point, demonstrating the extreme tightness in physical inventories. For traders and investors, this is a red flag. The disconnect between paper silver and actual silver in hand is widening, and history shows these moments rarely persist without triggering a significant price move. The cartel has tried to cap silver by linking its price movements to broader stock market fluctuations, creating artificial downward pressure. But these efforts are faltering. The market's synthetic overshoot, the gap between undersupplied physical silver and manipulated futures, has been exposed, with liquidity providers expecting a physically driven rally that could force shorts to cover. Every major round number is now a battleground. Spot buyers from China, India, and Saudi Arabia are steadily overpowering short sellers, making silver's upward potential increasingly hard to ignore. Meanwhile, silver is starting to reclaim its identity as both a monetary asset and an industrial commodity. The surge in spot premiums is a clear signal. Demand for immediate physical delivery is surging, and paper-based suppression is losing its grip. Investors holding bullion are positioned to benefit, while those relying solely on futures contracts risk being left behind as the market tightens. The takeaway here is simple. Silver is no longer just a secondary player to gold. It's being recognized globally as an undervalued asset with massive upside potential. Whether for hedging, industrial use, or monetary preservation, physical silver is gaining prominence, and the cartel's attempts to hold it back are increasingly failing. If you've been on the sidelines, now is the time to pay attention. In the next segment, we'll explore how the global gold market ties into silver's story, why China's accumulation strategy is critical, and what it means for your portfolio. Stick around. This is where the bigger picture starts to emerge. While silver is quietly building momentum, gold is in the spotlight for a very different reason: a tightening global supply that could push prices to unprecedented levels. And at the heart of this story, China. The gold market is facing a significant structural deficit. Annual supply falls around 900 tons, with projections suggesting it could reach 1,200 tons by the end of 2025. This shortage is not just a number, it's a force reshaping the market. As demand surges, particularly from China's long-term accumulation strategy, physical gold is being permanently removed from circulation. Every ounce entering China is effectively taken out of the global market, creating a permanent reduction in available supply for the rest of the world. This is why premiums on physical gold have widened dramatically, reaching levels not seen since 1979. Investors are willing to pay top dollar to secure tangible gold, highlighting a shift from paper contracts to physical ownership. China's strategy goes beyond simple accumulation. While official reserves may not fully reflect the country's holdings, when considering state-controlled entities and military reserves, China could be sitting on an estimated 40,000 tons of gold. The launch of the Shanghai Futures Exchange in 2024 has amplified this effect, allowing China to influence global pricing benchmarks while quietly hoarding physical metal. This move is strategic, positioning gold as a key tool in shaping the future of global financial settlements and increasing China's geopolitical leverage. Globally, this supply-demand imbalance has prompted major bullion banks to adjust their outlooks. Institutions like Goldman Sachs and Deutsche Bank have revised gold price forecasts upward, with projections now ranging between $4,200 and $4,800 per ounce. This revaluation reflects not just rising demand, but also the growing recognition of gold's scarcity. Every month of sustained accumulation, especially by large players like China, deepens the structural deficit, and investors who ignore this risk may miss out on a historic opportunity. While silver has been quietly rallying due to backwardation and physical shortages, gold's story shows the other side of the coin: long-term scarcity driving premiums and strategic accumulation. Together, silver and gold are telling us a larger story about global financial dynamics, investor behavior, and the growing power of nations hoarding physical assets. In our next segment, we'll connect the dots between China's physical gold strategy and the broader implications for silver, including industrial demand, monetary relevance, and why the gold-silver ratio could be signaling one of the most critical turning points in precious metals history. Stick with us. This is where the market's future really starts to come into focus. Silver is quietly breaking free from its historical correlation with broader stock markets, showing strength as physical demand surges. The gold-silver ratio, currently hovering around 1:1.1, signals extreme undervaluation of silver relative to gold. Historically, this ratio has ranged between 40:1 and 60:1, and such extremes often precede major price corrections. Investors who recognize this discrepancy may find silver positioned for a significant upward repricing in the near term. One of the clearest indicators of market tightness is backwardation in the silver spot market. For the first time in years, spot silver is trading consistently above futures contracts, sometimes nearly a full dollar higher. This structural disconnect, a clear signal of immediate physical shortages, cannot persist without influencing price movements. Analysts like Andrew Maguire note that strong buying in Asia, particularly in China, India, and Saudi Arabia, is driving this shift, gradually overpowering the traditional paper short sellers in the West. Each spot purchase adds pressure to a market already stretched thin, increasing the likelihood of short covering and a physically driven rally. The cartel's attempts to cap silver prices through synthetic selling are losing traction. Repeated efforts to suppress the spot price have been met with strong counter-purchases in the physical markets. Spot premiums over futures continue to expand, reflecting global demand and the scarcity of immediately deliverable silver. Large volume buyers in Asia and the Middle East are steadily gaining the upper hand, pushing the market toward what many describe as capitulation extremes, a classic setup for a sharp rally. Meanwhile, silver's industrial role adds another layer of bullish pressure. Its essential use in solar panels, electronics, and green technologies positions silver not only as a store of value, but also as an increasingly critical commodity in the transition to renewable energy. As industrial demand grows alongside monetary demand, silver's dual role magnifies its potential upside, particularly in markets where physical availability is constrained. Technically, silver is beginning to decouple from stock market movements, showing resilience even when broader indices face volatility. The growing disconnect between cash-settled futures and physical spot prices highlights a market under stress, ready to realign with tangible supply realities. For investors, the lesson is clear. Physical acquisition, especially of 1 Oz rounds and larger bullion bars, is becoming increasingly valuable in capturing both scarcity and industrial demand dynamics. In essence, silver is emerging as a unique investment at the intersection of financial hedging, industrial utility, and scarcity-driven speculation. As physical markets tighten and synthetic selling loses influence, the stage is set for a significant repricing that could reshape investor strategies across both gold and silver markets. China's influence on the silver and gold markets is becoming impossible to ignore. For years, much of their accumulation occurred quietly, but recent market activity reveals clear footprints of strategic buying. Liquidity providers now assess that China has cornered enough global silver supply to allow prices to move sharply higher. The combination of robust physical demand and the ongoing disconnect between futures and spot markets suggests a tipping point is near. Spot silver is trading consistently at a premium over futures, signaling immediate scarcity and the potential for a physically driven rally that forces short sellers to cover. The broader implications of China's accumulation extend beyond silver. Gold, too, is experiencing unprecedented demand. With global supply already in deficit, projected to reach 1,200 tons annually by the end of 2025, China's persistent buying further constrains availability for the rest of the world. Their long-term strategy is not only monetary, but geopolitical. Accumulating gold strengthens China's position in the global financial system and supports the ongoing development of a digital RMB as a potential settlement currency. The Shanghai Futures Exchange, launched in March 2024, has amplified this effect, allowing China to participate in benchmark gold fixes with greater efficiency and scale. Meanwhile, geopolitical tensions, particularly trade sanctions between the US and China, are creating an environment where gold and silver serve as hedges against currency instability. As China continues to sell U.S. treasuries and redirect those dollars into gold purchases, they are effectively insulating themselves against financial warfare. Silver, though smaller in market size, benefits from this dynamic. Strong industrial demand, especially in Asia, combined with physical scarcity, positions silver to break free from paper markets and deliver outsized returns for investors who recognize the trend early. The market signals are clear. Synthetic efforts to suppress silver prices are increasingly ineffective. Spot premiums are widening, backwardation persists, and Asian buyers continue to dominate physical acquisitions. Historical patterns suggest that once a critical mass of physical buying occurs, paper shorts are forced to cover, which can trigger rapid upside movement. For those holding physical silver, this could be the beginning of a new leg higher, where both scarcity and demand converge to create real, tangible gains. Additionally, global gold and silver markets are now intertwined with broader macroeconomic forces. With the dollar's status as a reserve currency under scrutiny and structural deficits continuing to mount, precious metals serve as both a monetary hedge and a safe haven. Investors who understand the interplay between geopolitical strategy, physical scarcity, and market psychology are likely to be best positioned to capitalize on these shifts. Silver, in particular, is emerging as a dual-purpose asset, a hedge against currency risk, and a critical commodity in the industrial economy. In conclusion, the global silver market is at a historic crossroads. With China and other Asian buyers steadily acquiring physical metal, synthetic suppression efforts faltering, and industrial demand rising, the stage is set for a significant repricing. For savvy investors, understanding these dynamics and positioning in physical silver could be the key to navigating the evolving landscape of precious metals successfully. As we look ahead, the trajectory of silver and gold is increasingly clear. Silver's undervaluation relative to gold, highlighted by the extreme gold-silver ratio above 100.1, signals that a significant correction may be imminent. Historical trends show that such extremes rarely persist without a strong upward movement. Spot silver premiums remain elevated, backwardation persists, and the fight between paper short sellers and real physical demand continues to play out. With China, India, and Saudi Arabia actively acquiring physical silver, the imbalance between available supply and growing demand is reaching a critical tipping point. Investors who recognize this pattern early and secure physical holdings are likely to benefit from both industrial demand and monetary appreciation. Gold, meanwhile, continues to experience extraordinary pressure from global accumulation, particularly by China. Current supply deficits, coupled with ongoing geopolitical tensions, reinforce its position as a safe haven. The combination of ETF inflows, central bank purchases, and physical repatriation creates a market environment where price growth is increasingly supported by fundamentals rather than speculation. Major financial institutions have revised their forecasts upward, with spot gold targets now exceeding $4,000 per ounce in the near term, reflecting both the scarcity of tangible metal and strong global demand. Technically, silver is beginning to decouple from broader stock markets, showing strength independent of macroeconomic volatility. As industrial applications, solar panels, electric vehicles, green technologies expand, silver's dual role as a commodity and a monetary asset becomes more prominent. For investors, this is a unique opportunity to balance physical exposure with strategic long-term positions. Purchasing bullion in 1 Oz rounds or 100 Oz bars, while avoiding collectible coins with lower liquidity, is generally recommended. Scaling into positions over time rather than investing all at once helps mitigate price volatility while capturing the market's upward momentum. Looking at the bigger picture, the current environment demonstrates a global shift in financial power. China's long-term accumulation strategy, coupled with tightening supply chains and ongoing geopolitical risks, is reshaping the precious metals landscape. Silver's scarcity and undervaluation relative to gold suggest that both metals are poised for continued upward repricing. Investors who act decisively, informed by market data and physical demand trends, are positioned to capture substantial gains as these dynamics unfold. Financial disclaimer: this video and the content provided are for informational and educational purposes only. Nothing presented here constitutes financial advice, investment recommendation, or an offer to buy or sell precious metals or securities. Investing in silver, gold, or any financial instruments involves risk, including the potential loss of principal. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions. Silver&Metal IQ, Peter, and affiliated contributors do not assume responsibility for any financial outcomes or losses. Thank you for following along with this series. Stay informed, stay strategic, and remember, owning physical silver and gold is not just about price speculation. It's about preserving wealth, understanding global dynamics, and preparing for what the market reveals next.